The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Can everyone see my screen and can everyone hear me this morning? Today, we're going to be looking at strategies for trading FOMC using binary options in spread combinations. Now, if you can hear me and see my screen, if you'll just type a Y in the question box, I would appreciate it. Well, thank you. Okay, now before we get started, I would like everyone to just read over the Nadex risk disclaimer. This is for your protection as well as ours. And I also want to remind everybody while you're reading over the disclaimer, you might want to also go and open up the free Nadex demo. And the reason is because education, which is what this webinar is your education. And you know, you have knowledge and then you have the application of knowledge. You know, if you just pop over or open up a demo account real quick, you can actually practice with me today during this webinar. Now, before we get started, I just want to kind of introduce myself to everyone. My name is Gail Mercer. I am the founder of TradersHelpDesk. I've got more than 15 years of trading experience. I like to limit it to that 15-year mark so I don't sound old. I actually started out with a company that programmed indicators and actually fell in love with the price bar. I do specialize in price action, volume analysis, and divergence because I believe they are leading indicators. I'm also a frequent contributor for Stocks and Commodities, Traders World, and Top Shelf magazine. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options, Keeping It Simple Strategies, The New Trader's Guide to Trading Nadex Binary Options and Spreads, as well as Trading Nadex Binary Options using currencies. Now, this is what we're going to be doing today. We are actually going to look at different techniques for trading the FOMC release. Now, for those of you that are not familiar with this market report, today is what they consider the quad FOMC. That means there are 4 FOMC releases. The one that sets this one apart is the economic projections. They actually started that in 2011 and became very consistent with the release dates in 2013, okay? Now, in addition to the FOMC economic projections, they also do the FOMC statement, the federal fund rates, and today there is, as of yesterday, it was 94.5% probability that they would raise interest rates today. And then at 2:30, you have the FOMC press conference. That actually consists of red statement and then questions, and it's really the questions that may move the market, because if they say something that they could interpret as to how many more rate increases or how do you think the economy is going to do, that can actually move the market a lot. Now, today we're going to be looking at different ways to use binary options and spreads, or just one, either one you want. I'm going to show you both how to do a directional and a volatility-based trade. Now, I want to make sure everyone understands the difference between the two, okay? A directional means that you have a bias, okay? You believe that the market will go up, or you believe the market will go down. You only take one trade, okay? And that trade will have risk associated with it, okay? But it's only risk on the one trade. Now, if you have a volatility-based trade, that means you don't have a bias, okay? You just say, hey, I don't know what the market's going to do, so I'm going to do both a long and a short. Now, you will give up some profits when you do that, okay? Because you're taking on risk on two different trades, a long and a short. So you've got two risks, and more likely than not, only one will actually make profit, okay? You also run the risk of losing on both sides of the market. Let's say we're expecting a 100 pip move today and it only moves 10 pips. You know, if you're using out of the money on these volatility based trades, then one or both would potentially lose. Okay. Now, before we go and look at what is available for today, I want to just let everybody know my contact information. My website, again, is TradersHelpDesk.com, and my email is gm@TradersHelpDesk.com. And again, just to reiterate, it would probably help you if you decided to go and open up a demo account to follow me with. And if you go to the Nadex.com site, simply click on the trading platforms. The link for opening a demo is under the demo trading platform, okay? Now, let's go and let's see what's available. Now, remember, the first market report on this does not come out until 2 o'clock, okay? So right now, the choices that we have would be the dailies, okay? Later on this afternoon, if you wanted to practice using a 2-hour binary, you know, again, having this demo account allows you to do that. Now, I personally like Forex. That's really the market that I love because it's a 24-hour market, okay? So I'm going to show you examples on Forex. You could also do this with the indices, okay? So let's begin by looking at the Forex binaries, and I'm going to focus on the USD JPY, okay? If we click on the daily 3 p.m., we can actually see all of the binaries that are currently being offered on the USD JPY. Now let's presume that you have a bias to the upside. Can you use the 20-minute binaries for the FOMC release? You could, but just understand that they're going to be moving very quickly. So if you don't have your demo platform set to limit orders, you know, I'm not sure what price you would get in at. Okay, if it's on market, you might incur more risk than you had anticipated. Okay, it is going to move very, very fast during the market report. So let's say that we have a bias to the upside. Well, you know, you could choose an at the money, okay? Price is currently trading at 106.36. The 106.40 is the one that has about $50 of risk, okay? So you could choose to enter this one. Again, one thing I really like about Nadex is it kind of puts the risk in your face, okay? Your maximum loss here would be 48. Your maximum profit would be 52, okay? Now, that's if you're using an at-the-money trade, okay? What if we wanted to go out of the money, okay? Well, this is really a good market report to do that on because you're expecting a big movement, okay? And again, you know, the one thing that I really pay attention to is what is this number, okay? In this case, it's 106.37, okay? Now, an out of the money means that price has not arrived yet at that strike. So for example, 106.60, that one only has $19.25 of risk. Again, if your bias is to the upside, you could actually enter this for $19 with the potential of $81 in profit, okay? Now you can see it just changed. It went to 26, back to 18. You know, these premiums change a lot, okay? So I use a limit order. And for example, we just got in this one, and the risk is $18.50. Now, how much does it have to move for this binary to actually make money? Right now it is at 106.35, okay? Now, as this moves closer to this strike, because we were able to get this as a very cheap premium, we may actually start making money when price gets to 40 or 45. This would be actually in the money, okay? Meaning that right here, you would show a profit just like it just did, okay? Does everybody understand that? So it doesn't have to actually get there, but as long as it's going in that direction, you can actually become profitable. Does everybody understand that? But you can also actually go in and set a profit target. For example, on this one, again, if my bias is to the long side and I entered this, and I would say, okay, I entered at 18.50, and if the premium goes up to $85, then I want to try to exit the trade, okay? And I simply set the order, and now you can see I'm in the market and I have an order at $85 to take me out. Does everyone understand that? It does not mean it will automatically be filled, okay? What has to happen is the bid price has to reach 85, and there has to be sufficient buyers and sellers in the market, okay? Now, what if I had a bias to the short side? Well, there's really not clear at the money for the short side, okay? In this case, I could go deep in the money at 106.40, or I could do the 106.20, okay? That one only has about 27.75 in risk if I'm able to get in at 72.25. Now, if I place this order, you'll see it sitting here because price is not there yet, okay? Then sometimes it might take a couple of minutes to fill this. Sometimes it won't be filled at all, okay? And that is because I use limit orders, okay? And again, if I wanted to go in and set a target on this, I could say, okay, if the market moves in my direction and the buy premium comes down to $15 in this example, then I can actually place that order. Again, it may or may not be filled. Yes, GTC stands for good till canceled, okay? So it's a limit order, and if you do change your mind, you will need to go in and cancel that order because it's exactly what it says, good until canceled, okay? Now, this is doing binary options, okay? Spreads is actually really good for trading this market report. Why? Because a spread is flexible, okay? In that you will only lose as much as what is the difference between either your entry price in the floor or your entry price in the ceiling, okay? It gets a little bit more complicated, okay? But It's not a problem. I'm here to explain it to you. Now, let's say that you have a bias to the upside, okay? You want to buy a floor, which is on the left-hand side, okay? So these are the floors, and your bias is to the long side. You have a couple of different options with the floor. Right now, you could buy the floor at 106.30. If you chose to do that, you would have about $22 of risk with the potential to make $128 if it goes up to the ceiling. The ceiling is on the right-hand side, okay? So I'm just going to place this order, but I do want to remind everyone that this webinar is for education only, okay? Now, you could also do a short, okay, by selling the ceiling, okay? Now, which one is the ceiling? The ceiling is always on the right-hand side, okay? So in this case, I want to sell the ceiling, which is a $20 risk, okay? So if I sell this, then I have both a long and a short spread. Between the two, okay, you would have, and I'm going to mark this on the screen, on this one, you have $22 of risk, and this is for the spread. And then on the short, you have about $20 of risk, okay? So in total, going both long and short, you have $42 of risk combined, okay? So let's say that the market goes up, and let's say that it goes up to 108, okay? What would be your potential to make on that trade? And let's say that at expiration, it is at 108, okay? That means that it moved the full width of the spread, okay? So your entry price was 106.52. Now, if you take the ceiling, which is 107.80, and you subtract where you entered, then that gives you the potential for you to make on this binary option. Does everybody understand that? Basically, $128 is your potential. Does everybody understand how I did that? In other words, even if it moves up to 108, the ceiling price is what caps the profit potential. Okay? Now, do you have to stick to all binaries or all spreads? No. You can actually mix and match them. Okay? For example, and we're going to do another one. And again, I just want to remind you, this is for educational purposes only. Let's say that we want to go short in a spread that already is in the money, okay? So in this case, you're going to risk $74 to make $76, okay? And I'm going to place this order, and this one is short, okay? So now I'm going to go over and look at the binaries and say, okay, is there a binary that could potentially cover that loss if I'm wrong? In this case, I'm really predominantly only interested in covering a loss if I'm wrong. Does everybody understand that? It's sort of like a protection order. You do buy the floor price and you sell the ceiling because that's your risk parameters, okay? Now, in this case, okay, I have a spread at 106.31. So I want to be able to cover this potential loss. So I'm going to actually do a long binary at 1675 that would potentially cover that. Does everybody understand that? Now, what does that really mean? Okay, well, let me put up a standard chart that I use. And we're going to just put some lines on it so we'll know exactly what this binary does, okay? Now, it's marked down here as number 2 because I already had that in there, okay? So we're going to draw a line on here where our entry price was on that spread, and that happens to be 106.31, okay? So right here, this tells me that that is a spread, okay? And this is my entry price. Now I'm going to do a blue line at 60, okay? Now, if it is above 60 at expiration, which is above this blue line, then I have the potential, if it expires above 106.60, I have the potential of making about $85, okay? Actually about 83, but we're going to say 84, okay? So if it expires above this, I have the potential to make $84. However, if it moves down and it moves the entire width of the spread, and I'm just going to put a line here and we're going to put this at 105, okay? If this moves down below this area and expires by 3 p.m. beneath the 105.55 area, then I also have the potential to make $74 on this side. Does everybody understand that? Any questions on that? So in this case, I have both a long and a short using a combination of a spread and an option. Okay. Now, we can also go in and we could actually draw these lines according to the other spreads that we did. Okay, we have a short at 106.10. That would be here. And then we have a long at 106, let's see, this one, 106.52. So we'll bring this line down to here. Okay, so anything above this line, if it expires in the money, we have made a profit on the long. Anything below the red line, provided it expires below that red line, would be profit, okay? Now the risk on both would be right at about $44, okay? Does everybody understand that? So what you would want is for one of them to actually exceed the spread. That's what you hope will happen. Any questions on that? Any questions? Does everybody understand that? Now we can also look at, okay, what has to happen on the binaries, okay? All right, on the binaries, we have one at 60, and then we have one at 106.20. Okay, in this case, the risk on these, one had about $28, one had, I believe it was right at 20, so let's just say 45 combined. Okay, that still leaves a profit potential of 55, provided that by 3 p.m. today, price expires under 106.20 or above 106.60. Okay. The last one is clear. Could you explain the previous example? Okay, we have one that's already in the money. In other words, it has value because price is already trading within that range. Okay, and that is this one. Now the price on that one was 106.31. So let me bring this to 106.31. And you can see this is where price is currently trading. Okay. Now, the bottom of that is at 105.55. That's where the floor is. So let me just put another line on here for 105.55. Okay. So now we have 105.55, and I'm going to make this yellow because that tells me that that is the floor for our short spread. Okay. Now we did a binary at 106.60. Okay. Now that binary basically had right at about $15 of risk. Okay. Actually 17. We'll put 17 on here. Okay. Now, if price goes up and it goes against us, and let's say that it expires up here at 107, okay, then on this one, we will have made about $83, okay? I started to say 84, but it's 83, okay? But we would have lost on the spread, and the spread is here, okay? So our entry price was 106.31. The ceiling price was 107.05. Okay. So if we subtract these, then we have $74 of risk on the spread. Do you see that, Antonio? So this one, the risk is 74. But what is the profit potential? Okay, well, the profit potential is our entry price, which is 106.31, minus the floor, which was 105.55. So basically $76 is your profit. If price expires lower than the floor. It actually could be at the floor or less than, okay? Because your profit potential is from here to here. That's the way the spreads work. Do you understand that now, Antonio? So if, for example, the price goes against us and actually expires above this area, then we would be able to recuperate the loss on the spread, okay? Now, what if it moves in our direction, okay, and it comes all the way down here, okay? And I mean, actually, that's within reason for this market report. Well, in that case, you would have potentially made the $76 minus the $17 that you paid for the binary, okay? So basically, you would make about $59. Does everyone understand that now? And when you're doing these, it's all about what I call shopping around. Okay. It's, what's the risk that you can live with versus the reward that the binary or the spread will pay out. Does everybody understand that? And sometimes this takes a lot of practice to get. A lot of times I actually will do multiples. I'll do some with binary, some with spreads, some that use both, but when I do like the binaries, I try to keep the risk between 30 and 40 for both sides if I'm doing a volatility trade. And again, what does the volatility mean? It means that you have two trades with risk on at the same time. You're going in both directions. You don't care how it moves. You just want it to move. Does everybody understand that? The more you work with these, the better you get at it. You're right. And I know today we're typically, historically, you're going to have over 100 pip move. Okay. So I know it's fairly early right now. I normally don't do my trades until, about 10 minutes before the release is coming out. But let's look at where it's trading right now. You've got 106.28. Where could it potentially move? Well, if the market report was going to be released right now, then the potential for this would be to move up to 107.28. And I'm going to expand my chart so you can actually see this. Okay. And potentially down to 105.28. Now, this is measured 1 hour of movement from high to low, okay? So let's presume it was 2 o'clock. Price could go all the way up here or it could come all the way down here, okay? That's the type of volatility that we are likely to see today. Does everybody understand that? Now, what's the strike width of a 2-hour binary? On the USD JPY is 4 pips. Okay, that's a big move. I usually do the 1 to 3 p.m. and the 2 to 4 p.m. And sometimes it's a matter of shopping around. Okay. For example, right now I'm just showing the daily, okay, because it's not 2 o'clock yet, basically. But, and I'm going to show you this using the 1 to 3 p.m., okay. Let's refresh it real quick. All right. So I've refreshed it and I'm going to look first at the dailies, okay. And say, okay, right now price is trading at 28. If I wanted to go 1 to 2 strikes out, I could go to the 106.80 at $12. Does everybody see that? Or I could do the 106.60 at 15. Okay. Well, could I get the 1 p.m. to 3 p.m. cheaper? Okay. If I went out to, let's say 58, do you see how that's $17? But I could get the other one for 15. So I'm saving $2 by using the daily 3 p.m. Does everybody understand that? And the same thing on the spreads, okay? Let's say that you're looking at going on the Forex spreads, and let's use the USD JPY. Okay, the 1 p.m. it's got $27 of risk. Okay, does everybody see that? Your numbers are going to be slightly different, but this is what I'm looking at. Okay, this one right here. So that's going to have $27 of risk. Okay, well, could I get it cheaper using a different expiration? So this is the 3 p.m. Let's go to the 1 p.m. That one's got 26, so I'm going to save $1. Do y'all see that? I call it bargain shopping. Shopping. Does everybody see that? It's which one is going to give you the acceptable risk level. Okay. I don't see a big difference with the spreads typically. I do on the binaries. Okay. And the reason is the 3 p.m. Will be expiring in 2 hours. So for a daily with only 2 hours to expiration, it's going to have more time decay than, let's say, the 2-hour binary that still has 50% of the time left. Does everyone understand that? Now you can also go in and set up targets for your spreads. Let me move this out of the way for a moment. For example, this one, okay, and this is what you need to pay attention to is where did you enter, okay? And if you're going to be setting targets on these, this is what you need to do. For example, on this one, I'm short because it's a -1 there, and my entry price was 106.1. So I want to set a target on here, and to set the target, I know that my floor is at 105.55. So I'm going to come $10 above that, or 10 cents above that, which would be, wait a minute, this is the one I'm looking at, it's 104.80. So I'm going to set a target at 104.90, okay? Does everybody understand this one? And then just simply place the order, okay? Also, I'm going to set one here on the 105.55 to 107 and say, okay, if this pops down for whatever reason to 105.65, then I want my order to be sitting there. And we can also do that on this one. And again, look at your prices, okay? My entry price was at 52. The ceiling price is 107.80. So in this example, I'm going to set my target at 107. Let's do 65, okay? It's $15 under the ceiling, okay? Now, what happens is, let's say that the market reports do come out, and by 2:30 today, it could actually move, and this price would be at 104.90 or 105.65 or 107.65. My order could actually be filled. Now, again, you have to have sufficient buyers and sellers, but as long as my order is there, then I have a likelihood of being filled. Does everybody understand that? Are there any other questions today? The big thing to remember is if you are going in both directions, just remember that you have risk on both directions. versus a directional where you only have risk on one side. Okay. All right. I want to thank everybody for joining me today. I hope you enjoyed the webinar, and I hope you have a wonderful afternoon.